Hello students, now I am going to explain about the marginal costing practical problems. Previous class already we discussed about the theoretically. Now I am going to explain practically. So when they will give the practical problems, how to solve it. Marginal costing problems all are based on the marginal equation only we are going to do. So if you observe the slide, income statement under marginal costing, sales minus variable cost, contribution, contribution minus fixed cost, profit. So same this we are going to show in marginal costing equation, sales minus variable cost, that is contribution, that is equals to fixed cost plus profit. So in marginal costing the following formulas are we are going to use to calculate that contribution: sales minus variable cost, that is the contribution, and also we can calculate that fixed cost plus profit, that is also contribution, and profit volume ratio. To calculate this profit volume ratio, contribution by sales into 100 and the changes in profit in changes in sales into 100, also we can calculate contribution. Sometimes instead of these two, the change of contribution in change of sales also we are going to use. To calculate break even sales, in value fixed cost divided by profit volume ratio, you will get the break even volume, and when you are calculating break even sales in number of units, fixed cost divided by contribution per unit, you will get the number of units at the point of break even. Margin of safety. To calculate this margin of safety, we are going to use in marginal costing two formulas, that is the difference of actual sales and break even sales. It is nothing but a actual sales minus break even sales, and also we are going to use one more formula, that is profit divided by profit volume ratio, you will get margin of safety. So required sales and required units, to calculate that fixed cost plus profit. To sales we are going to take contribution per unit, and in units we are going to take the profit volume ratio. First I will explain the contribution. From this information you can calculate contribution and profit. Problem number 1, a company sells a product for 50 per unit, the variable cost per unit is equal to 30 rupees. A company sells 10,000 units, fixed cost amount is equal to 1 lakh rupees. Calculate contribution and profit. Here to calculate contribution, we have to take the selling price per unit and variable cost per unit. The difference of selling price per unit, variable cost per unit is equal to contribution, that is 20, and total contribution, here number of units sold and contribution per unit, that is nothing but a 2 lakhs. So profit, to calculate that profit, already we know the contribution is equal to fixed cost plus profit. When you know the fixed cost, automatically you can deduct from the contribution, you will get the profit. That is here I am showing profit is equal to total contribution minus fixed cost. Here total contribution, that is 2 lakhs, minus 1 lakh is the fixed cost, remaining 1 lakh is the profit. Next, break even point. So break even point, already previous class I explained, break even point means when there is no profit, no loss, when our revenues are equals to our cost, so that is called as a break even point. The point at which no profit and no loss, that is called as a break even point. From this information you can calculate break even point. A firm has fixed cost 1,50,000, the selling price per unit is equal to 40 rupees and variable cost per unit is equal to 25 rupees. Find out the break even sales. To calculate the break even sales, first we required that contribution per unit and also fixed cost we required. In fixed cost, in the problem they given directly 1,50,000. Now we have to calculate the contribution. So contribution per unit is equal to selling price minus variable cost, that is 15 rupees per unit of contribution, and fixed break even point in units, fixed cost divided by contribution per unit, total 10,000 unit, that is break even point. When we sold the 10,000 unit, that time we are going to reach our break even point. If you sell exceed of the 10,000 unit, you will get the profit. If you sell less than 10,000 units, you will get the loss. And next one is the margin of safety. So, already margin of safety means what? Already I clearly explained in the previous class. Again I am explaining that margin of safety means the difference between actual sales minus break even sales. The difference between actual sales and break even sales. Whatever sales exceeds after break even sales, that is called as a margin of safety. From this information we have to calculate the margin of safety. If a company has actual sales 6 lakhs, a break even sales are 4 lakhs, calculate the margin of safety and its percentage. Simply to calculate that margin of safety, just you can deduct this break even sales from the actual sales, you will get the margin of safety. Here I mentioned that actual sales 6 lakhs, break even sales 4 lakhs, total 2 lakhs is the margin of safety. That margin of safety we are going to show in the percentage, that is 2 lakhs divided by entire sales 6 lakhs. It is nothing but 33% of the margin of safety. So, these are the basic information about the marginal costing. Now, we are going to solve the advanced problems in marginal costing. Now, the problem X Limited made the sales during the certain period for a rupees 1 lakh. The net profit for the same period is 10,000 and fixed overheads are 15,000. Find out the PV ratio. See, according to marginal costing equation, we have 3 variables here: sales they given, and profit they given, and fixed cost they given. So, we have to calculate PV ratio, required sales to earn the profit 15,000 and net profit sales of rupees 1,50,000, net profit from sales of 1,50,000 and break even point sales we have to calculate. First, to calculate the PV ratio, what we required? Contribution and sales we required. Contribution, how we know that? Here already there is a clue for the calculation of contribution. Fixed cost they given, profit also they given. So, fixed cost plus profit, it is nothing but a contribution. So, 25,000 contribution. So, contribution divided by sales 1 lakh. So, here I mentioned that 25,000 divided by 1 lakh of the sales, that is PV ratio is equal to 25%. And second problem, second question they are asking about the required sales to earn the profit of 15,000. To earning a 15,000, how much sales we have to be maintained? So, for that here we have to take here fixed cost already they given, fixed cost cannot be changed, only profit can be changed. So, in sales we have to calculate the sales. Here to desired profit, desired sales, to calculate that we are going to use the formula, that is 25% is the PV ratio and required fixed cost is equal to 15,000 and required profit is equal to 15,000. Total contribution is equal to 30,000. That is when they given the profit. So, automatically, so when there is a sales of 1,20,000, 25% is the PV ratio, it includes 30,000. So, 25% equal to 30,000, then 100% is equal to how much? So, that is nothing but a 1,20,000 sales required. When 1,20,000 sales are there, that time you will earn the 15,000 of profit. Simple. Here PV ratio is equal to 25%. That 25% amount is equal to 30,000. So, 25% is equal to 30,000, then 100% is equal to 1,20,000. So, this is the sales which required to earn the profit of 15,000. Next one is net profit from sales of rupees 1,50,000. So, when there is a 1,50,000 sales are there, what is the net profit? Simple, here we can calculate sales into PV ratio minus fixed cost, you will get the profit. So, sales already 1,50,000 already they given, 25% of that PV ratio we taken. So, that is nothing but a 37,500, already fixed cost we know that. So, 37,500 minus 15,000 is equal to 22,500. So, here to earn the profit of when the 1,50,000 sales are there, that time our profit is equal to 22,500. And what is the break even point? So, break even point, to calculate the break even point, we have two methods, that is fixed cost divided by PV ratio, or PV ratio is equal to fixed cost plus break even sales into 100. Here you can take that when there is a already we know that 20 PV ratio we know, already fixed cost also we know. So, 25% equals to the 15,000 and 100% is equal to how much? So, 60,000 is the break even sales. Next. So, sometimes instead of giving direct problems, they are going to give the 2 years data. 2 years data also they are going to give sales for the 2 years and profit for the 2 years. So, from these informations we have to calculate PV ratio, break even point, total variable cost for each year and sales required to earn the profit of 60,000 and profit on loss when the sales are 1 lakh, margin of safety when the profit is 80,000. So, here individually we have to calculate. Here to calculate that PV ratio, first we have to take the difference amount of the sales. Not only different amount of the sales, we have to take the difference in profit. To calculate the PV ratio, the formula is change in profit divided by change in sales. So, here change how much we identified, 50,000 minus 20,000, 20,000 change of profit is there, and 2 lakhs minus 2 lakh 50,000 sales, from here 50 lakh sales also there. To calculate the PV ratio, change in profit and change in sales. So, here 20,000 divided by 50,000. So, that is nothing but a 40,000 of the PV ratio. So, once you calculated the PV ratio, we have to calculate the break even point. To calculate the break even point, here we required fixed cost, but we do not know the fixed cost. So, first before calculation of break even point, we have to calculate the fixed cost. Fixed cost, how we are going to calculate that? Here already we know the profit. So, another two variables, what is that? Variable cost we do not know, fixed cost we do not know. So, we have to find out, to calculate the fixed cost, we have to take the help of PV ratio. So, PV ratio includes 40%. In this 40% it is includes fixed cost and profit. So, that already here profit we know that for year 2005 and 6 the profit is 50,000, and what about that fixed cost? So, 40% equals to, for whatever the sales are there, 40% is contribution. So, out of 2,50,000, 40% is equal to contribution. That 40% includes that profit as well as sales. So, here almost 1 lakh is the contribution. 50,000 out of this 1 lakh, it is included both fixed cost and profit. So, 50,000 is the profit, remaining 50,000 is the fixed cost. So, after calculation of fixed cost, we can use that fixed cost amount and we can calculate the break even sales. So, 50,000 divided by our PV ratio 40%. So, that is nothing but a break even sales 1,25,000. Always you have to remember. So, when they given 2 years data, we cannot calculate the fixed cost directly. First we have to calculate PV ratio, that PV, with the help of that PV ratio in sales volume we have to calculate the contribution. After calculation of contribution, whatever profit they given, that profit we have to deduct, remaining balance is the fixed cost. So, after that total variable cost for the both years we have to calculate. So, total variable cost already we have to calculate. So, here variable cost, how we are going to calculate? Total variable cost we need to calculate. To calculate the variable cost, already 3 components already we have that information. Sales we already know that, and profit also we know that, and fixed cost also know that. So, here from here only we can calculate if you know the fixed cost. For example, whatever the variables are there, just you can substitute the variables into the marginal costing equation. Sales already we know that, sales 2 lakhs, and we do not know the variable cost. Now we are finding the variable cost. Profit already profit 30,000 they given, and for the year 2021 50,000 they given. Fixed cost just now we calculated, that is 50,000. So from sales you can deduct this profit and fixed cost. For the year 2020, if you deducted this profit 30,000 plus fixed cost 50,000, total after deduction of 1,80,000 from 2 lakhs, remaining 1,20,000 is the variable cost for 2020. For the 2021, there is sales 2,50,000, profit 50,000 is there, fixed cost also 50,000, because fixed cost does not change for year to year, it is constant every year. So already fixed cost just now we calculated, profit already 50,000 there. So 50,000 profit plus 50,000 fixed cost you can deduct from the sales, remaining portion is the variable cost, that is 1,50,000. I will show that amount. So here 1,20,000 is the 2020 and 1,50,000 is the 2021. So this is the way to calculation of variable cost when they will give the 2 years data, sales and profit. And next one is the, we have to calculate sales required to earn the profit 60,000. It means what? To earning the 60,000 profit, how much sales we have to be maintained. So that is very important. So here already we know the sales. So already we know the profit, already we know the fixed cost. So simply you can take the you can calculate the contribution. 60,000 plus 50,000, 1,10,000. So that's 1,10,000 is equal to 40%, and 1,10,000 is equal to 40%. Then 100% is equal to how much? So that is nothing but a 2,75,000 is the sales. So to earning profit, here fixed cost 50,000 I taken, profit 60,000 I taken, and PV ratio, that is 40%. So required sales are 2,75,000. To earning 60,000 profit, we have to sell at least we have to sell exactly 2,75,000. When you sell the 2,75,000, you will get the 60,000 profit. If you sell the below 2,75,000, we are not able to get the profit of 60,000. And next one is the profit and loss when the sales are 1 lakh. See, when the sales are 1 lakh is there, here sales 2 lakhs is there, and 2021 2,50,000 there. When the 2 lakhs is there, that time the profit is equal to 30,000, and when the 2,50,000 is there, the profit is equal to 50,000. If the sales are only 1 lakh, what is the profit? So that we have to calculate. Simply already we know the PV ratio, sales into PV ratio 40,000, that is 1 lakh into 40% means 40,000, and already we know the fixed cost. So 40,000 is the contribution, so that fixed cost is equal to 50,000. So here fixed cost is more than the our contribution, we will get the loss. I will show the answer. So here PV ratio 50,000, if fixed cost is 50,000 and profit we do not know, but sales already they given, that is 1 lakh. So sales in sales total PV ratio is equal to 40%, that is nothing but a contribution, it is 40,000. 40,000 and fixed cost is the 50,000. P is equal to how much? So P is equal to, the contribution is very less than the our fixed cost. So contribution when it is less, we will get the loss. So 10,000 is the loss. And next one is the margin of safety. So when margin of safety, profit is equal to 80,000. See here, margin of safety we can calculate directly with the help of these 2 years data. Generally the sales minus, already we calculated point B, break even sales, that is break even sales 1,25,000. So 2 lakhs minus 1,20,000, that is the break even margin of safety for the 2020. For 2021, margin of safety 2,50,000 minus 1,25,000, that is the margin of safety. So here separately they given margin of safety when the profit is 80,000, what is the margin of safety? So when they will give the separate profit For that calculation margin of safety, simply you can take the profit divided by the PV ratio, you will get the margin of safety. Here 80,000 divided by 40%. So, 80,000 divided by 40%, it is nothing but almost here we required margin of safety 2 lakhs. So, margin of safety is the 2 lakhs. So, this is the one more method, and sometimes, so this is the way to calculate this all the variables. First, step by step we have to calculate. So, next problem, sometimes they will give the year and sales and cost. So, that time we have to calculate the profit. So, when they will give the instead of giving this profit, they will give year sales cost, then we have to calculate profit, here. If you observe this problem, the sales and profits of JK Limited during the 2 years were given below. Sales they given, total cost also they given. Actually profit they not given, this is sales and cost only they given. When they give the sales and cost, we have to find out the profit. After calculation of profit, same whatever procedure we followed, same similar methods we have to follow. So, to calculation of PV ratio, simply first step you have to calculate the profits, the difference between the sales and total cost, that is nothing but a 40,000 of profit for 2010 and 50,000 for the 2011. After calculation of that profit, difference amount of profits we have to calculate. Difference amount of the profit nothing but a 40,000, 50,000, 10,000 is the difference in profit. In sales difference is 40,000. So, first we have to calculate the PV ratio. 10,000 divided by 40,000, that is nothing but a 25%, already I mentioned here. Next one is the break even point. So, what same procedure we are going to follow. The once you know the PV ratio, we have to calculate the fixed cost. So, previous problem and this problem is very similar, but previous problem they given only they given sales and profit, but in this problem they given cost and total sales. So, after calculation of profit, whatever procedure we followed previously, same method we are going to follow. So, this is the way to calculation of PV ratio, this is the way to calculation of profit volume ratio and contribution and required sale to earn and required sale to profit. Same method we are going to follow. So, from this table you can identify the two variables, that is sales and total cost. So, previous problem they given sales and profit, but in this problem they given sales and cost. So, when they given sales and cost, we are not able to calculate this all these things. So, here first we have to identify the profit. Profit, how we are going to identify that? Simply the sales already we know, the cost of sales also we know, the sales minus cost of the sales, that is profit. For each year we have to calculate the profit. So, 3 lakhs is the sales, 2,60,000 is the cost. So, remaining 40,000 is the profit. Similarly, we have to calculate for the year 2011. For total sales, here 3,40,000 is there and total cost 2,90,000 is there. Here the profit is equal to sales minus total cost 2,90,000, that is 50,000 is the profit. So, in this case first we have to calculate the profit, then after calculation of profit, this all we are going to calculate. First we have to calculate PV ratio, we have to calculate break even point and sales required to reach the profit 40,000 and profit made sales amount of 2,50,000 and margin of safety sales when the sales are 2,50,000. So, PV ratio, calculation of PV ratio. Here already I taken that profit, I calculated the difference of profit. So, change in profit is 10,000, change in sales is 40,000. To calculate the PV ratio, 10,000 divided by 40,000, that is 25% is the PV ratio. Once you calculated the PV ratio, next we are going to calculate break even point. So, to calculate the break even point, we require the fixed cost. When the sales are 3 lakhs, so when the sales are 3 lakhs, the profit is equal to 40,000. So, here this to calculate the break even point, we required profit as well as fixed cost. So, here we do not know the fixed cost, we know only profit. So, but we have a clue to calculate the fixed cost with the help of that PV ratio. PV ratio is equal to 25%. So, 25% of these sales, that is nothing but is 75,000. Out of 3 lakh sales, 25% 75,000 is the contribution. When the contribution is 75,000, once you deduct the profit, remaining 35,000 is the fixed cost. So, when you know the fixed cost divided by the PV ratio 25%. So, that is the break even point. So, here if you observe that 35,000 divided by 25%, total 1,40,000 is the break even sales. Next one is the same, similarly here also sales required to reach the profit 40,000. Here to getting the 40,000 of sales, how much sales should be we have to maintain. Here already fixed cost we know that is nothing but a 35,000 and fixed cost is equal to 35,000 and profit also they given to earn the profit, that is 40,000. So, total 75,000 is the 25%. So, this is exactly sales when there is a 40,000 of sales, when there is a 40,000, it is compulsory we need to maintain the 3 lakhs of the sales. So, it is automatically whatever the actual data is given in the problem, that is also very similar to this one only. So, just you can observe that here 40,000 is profit, 3 lakhs is sales. So, same only. Next one is profit made when sales amount are 2,50,000. So, what is the profit when the sales are 2,50,000? So, here already we know that when the 3 lakhs is sales, 40,000 is the profit, when 3,40,000 is 50,000 is profit, but when the sales are 2,50,000, what is the profit? So, already we know that fixed cost is 35,000, total 25% is the PV ratio, 2,50,000, that is 25% is nothing but a 50,000. Required sales to earn the profit of 35,000, when the sales are 2,50,000, what is the profit? So, here 25% is equal to that contribution. So, 25% is equal to 35,000, 25% of this 2,50,000, that is 62,500. So, out of this 62,500, already fixed cost we know that 35,000. After deduction 35,000 from 62,500, remaining 27,500 is the profit. This 27,500 when the sales are 2,50,000, this is the profit you will get that. And next one is the margin of safety. So, margin of safety already they given sales. When the sales are 2,50,000, already break even sales also we know that 1,40,000. So, 1,10,000, the difference amount of total sales and break even sales, that is 1,10,000. So, this is the margin of safety. So, these are the techniques which we are going to use in marginal costing techniques, and it is very helpful to the management to take a decision making whether they want to production continue or discontinue, they want to increase the production and expand the business, and also to estimate the profit and to know the break even sales. These all the situations we are going to use the marginal costing. Thank you.